these factors should have an impact on the decisions you make about investing in Ontario, whether you're buying or whether you're thinking about selling some of your properties. I do see people doing well in that. And I think that that's the type of deal where you have minimal downside. Because I see a lot of people shifting into that. Definitely, it's a time to pivot is what I'm seeing. And just because to me, the relative return looked good. I'm giving you information so that you can take that and say, hey, how do I want to use that information? Welcome back to REI Hot Seat. Andrew Hines here for a solo episode. Today, I'm going to be talking about what's happening in the market. What are the macroeconomic factors I think are at play here and that you're going to want to be aware of, because these factors should have an impact on the decisions you make about investing in Ontario, whether you're buying or whether you're thinking about selling some of your properties. Maybe this stuff will come into play. That's why I'm here to talk about it. So I'm going to be doing some screen shares here. First thing I wanted to just go over is inflation rate. So starting with inflation rate, obviously that's based on a consumer price index that Canadian government, Stats Canada, tracks, and of course they adjust that favorably. So if you notice whatever these rates are, 7-8% back last year, and then of course now they're getting into 3.8, and they were down to 2.8 in July. I mean, that doesn't mean that it's actually that all of your expenses were actually only getting 2.8% more expensive year over year from the previous July. That just means that according to their calculation, it was. I mean, some people I see it's, post on Instagram that something at the grocery store cost them double what it did 2 years ago. So obviously that, 2, even 7% doesn't apply to that. So I think most people are acknowledging it in food, and that's not really where I wanted to go with this anyway. Okay, so what does this really mean? Well, let's just boil it right down. People are kind of hurting right now. We know that. There's obviously a lot of people who are, they've had their mortgage payments, climb by 40, 50%. Some people just really weren't in a position to accept those changes. And then we have the people who it hasn't yet affected. They're still paying more for groceries and everything else, but then they're going to have those renewals. So there's a lot of people who are struggling right now compared to where they were a little while ago. And what this does is this creates consumer uncertainty and investor uncertainty. And when you have investor uncertainty, what happens is more people flock towards government bonds. This is where our mortgage rates come from. Our fixed mortgage rates are basically just a premium on top of our bond yields. So, 3-year bond or your term there, your 3-year mortgage rate is going to be similar, plus, maybe 1-2%. I've experienced banks specifically say we do 250 basis points above what you see. That's for commercial lending. You could kind of work this out and loosely figure out how they're coming to that, but it's usually around 2% from what I've seen. So knowing that that's happening, I mean, it's the real thing that this does is it makes it so that investments in Ontario don't work. I mean, how can I go and buy a house at roughly the same price it was 2 years ago and pay an interest rate that's like 5% higher than 2 years ago? The market just didn't calibrate to allow for a return at those prices and those rates. And what we're seeing now is people are still in maybe a bit of denial. See, the market's not just going away, because obviously there's immigration, there's housing crisis, there's still a need for places to live. But investors, as far as I can see, are in large numbers stepping aside. And I mean more of your conventional buy and hold, turnkey buyer. Those are not as prevalent. And if they are still floating around, I'm always curious to hear what they're investing in and how they're making it work, because I talk to a lot of people about this stuff, and I want to know. I want to know what's working, what's not working. So this is why I say, and I've sort of been saying this for quite some time now, that real estate is no longer sexy in Ontario, in Canada in general, and even more broad than that. All those people who were just, they knew their friend, bought a condo and made $300,000. Those stories are evaporating, because the people who were saved by the market before, they're not saved by the market anymore. They're going to have to be better. Now, everybody who was a skilled investor now needs to be a super skilled investor, because even skilled investors would have deals where they would run over budget. I've had that happen. I've run over budget on a renovation, and the market saved me. But what if it didn't? What about those cases where it doesn't? So people are going to have to be wiser, or they're going to do what I have seen, and I'm actually hosting a webinar on this. They're going to be shifting into more passive investments, private lending, private equity, things where your own specific skill isn't necessarily needed as much. Not to say you don't need skill in selecting investments. You do, and you need to speak with competent advisors and what have you. But I am hosting a webinar on that. If you're interested, I'll make sure that the link is in the show notes. So it's going to be starting November. We're going to talk about passive investing because I see a lot of people shifting into that. In fact, I just threw some money at some passive investments just because to me the relative return looked good. So definitely it's a time to pivot is what I'm seeing. And I just wanted to point that out. So now let's look at the housing market. So this is a handy little website. It actually has some of the year over year changes. Looking at the average home price in these different provinces, and you can see that some of them are down, some of them are up a bit. Ontario is up on the monthly, annually even. How that's possible, I don't even know. 2%, 2% isn't huge, so it's roughly stagnant. Quebec's doing quite well. Everything's up seemingly a little bit. However, it's not a meaningful change. It's not the 10, 20%, 30% we were seeing during the lockdowns. And generally speaking, we've had a lot of up and down. We had our initial rise to the top, and then things started coming down, and then they sort of leveled off several months back. And now they're back to sort of declining month over month in several different areas. So you're seeing that here in the fall market. Again, what does this mean? Well, I don't see this changing anytime soon. We're going to need a pretty severe recession, people to lose their jobs, all that kind of stuff for them to actually lower the interest rates. And if you've been following me for a while, I've been saying it seems like they're trying to break something. And I think that's, if you boil it down, that's what they're trying to do in every single high inflationary situation throughout history is they keep rising the interest rates so that the plumber holding a hammer, smashing it on a pipe, trying to fix a leak. That's the Canadian government smashing with these high interest rates. They're trying to hit just hard enough to spring, to maybe, bend the metal and stop that leak, if that makes any sense. But what often happens is they end up, breaking the pipe and things spray everywhere. They're gonna break something here. I don't see that there's a way to delicately do this. There's gonna be that straw that broke the camel's back. And this was my thought about this for a long time, is that when they finally do get to the market responding to recession, it'll be like you just pulled out the last little thing holding everything from just pouring out. And maybe we do see a more balanced market after that. Maybe it stagnates. I think that's very possible, or a slow decline. I just think, like, if you look historically, there have been times where it's, especially in the 90s, where it took a long time for real estate values to fully recover to their highs. So it was like right around the start of 1990, the peaks that they had right around then, it took until about 2002 to recover those highs. And that could be a scenario that we're looking at again now. So if you have a long-term time horizon in Ontario, it may just work out really well for you. You may be willing, if you have good cash flow, if you're locked into longer mortgage terms, you may want to just hunker down and ride it out. Because I do think on the other end of all this, and as I've said, is I think real estate goes to a place where no one can ever afford it again. And then we just have institutionalized ownership. We'll have large funds that own all the real estate in Canada. That's where I see things going. So you'll have a select few property owners that really do survive. But a lot of the middle class will just be wiped out. I've said this a lot. Doesn't mean it has to affect you negatively. I'm giving you information so that you can take that and say, hey, how do I want to use that information? Do I want to go out right now and start an active business in real estate where I'm buying stuff significantly under market value? There's one strategy that works in a declining market. So I think that even if it's not a declining market, because I can't say that it is or isn't, I've seen trends that make sense, but even if it's not a declining market, I want to be picking strategies that will work in a declining market, which means I want to buy properties well under their market value on acquisition so that I have a buffer if things keep going down. I could flip in that type of market. I could wholesale, where I just buy it, list it, close on it, list it for sale, and sell it on the MLS at still a discount, but take a margin on that. These are the type of strategies that I think still work now. but we'll see what else will work. Also, other active strategies like Airbnb arbitrage. Again, nothing's for sure, and just because it works now doesn't mean it'll work in 2 years from now. Typically, hospitality is seen to decline in times of recession. But what I like about that strategy, where you're basically just going and renting out an apartment, buying some furniture, and then putting it on the market and renting it out, is your investment's pretty low. And generally, the payback I've seen with most investors is 6 months or less. If you're not paying back all your investment to get into that deal within 6 months, then that would be atypical, I would say. Unless you're not doing a good job. Yeah, in full disclosure, some people just make mistakes and get into a bad one. And you could still lose. You'll want to structure your lease as well. I'm not giving any advice on any of this. Definitely consult some professionals if you're going to go down that route. But I do see people doing well in that, and I think that that's the type of deal where you have minimal downside. And the big thing you want to think in a time like this is, how do I mitigate downside? And so I'm big on the off-market stuff right now. I'm rolling out some strategies for that. Again, it's about buying at the right price for now. So what's changed, and as I've said, real estate's not sexy anymore. The passive investor doesn't really exist anymore, but it never really did. Real estate investing never was passive. There was always an active element. It's just how much. Now it's people who are business owners and business operators that have businesses tied to real estate. So for instance, I have a hospitality business that is a campground and a cottage resort on the water. They're tied to real estate, but they're active businesses. So there's ways to create income, cash there. Another one that works outside of this Airbnb arbitrage idea, and the business is tied to real estate, is development. Well, I guess that's also a business tied to real estate. So taking parcels of land and adding a ton of value. Now, the thing you got to be careful about there is, one, your borrowing costs are higher, and two, your end valuations could be a lot different than you think they are right now. Like developments in Canada, you're probably typically if it's a large scale development, a 5-year time horizon. A lot can happen in 5 years. So if you are going down that road and you are getting into that type of investment, you're going to want to make sure that there's a lot of meat on the bone. That's just my 2 cents with that. So let me check my notes here. So, immigration's the other one I wanted to touch on. No, there are no guarantees that continues forever. So I've often said we have a little bit of you have competing forces. We have immigration on one side, and we have we have interest rates on the other. They are competing and pushing housing prices around, because you have this artificial demand created by bringing a whole bunch of people into the country, and then you artificially suppress demand in the other direction by jacking these interest rates. So, but there's nothing to say that people don't start to see Canada as a place that's not really the land of opportunity that it once was. I don't think we're that close to that, but we could see less applications, and I've already seen indications that that's the case. But how long until there's a meaningful change on that front, I couldn't really say with the information I have in front of me here. Okay, so concluding thoughts here is, don't be a victim of circumstance. There is a way to make money in every economic climate. And just because the Canada as a whole macro look will say, most likely we're going to see real estate values to continue to come down to some degree. And I don't know that exact degree. Most likely. But I also expect them to go up in the long run. So knowing that doesn't mean every single market performs that way. You could have some cities where new employers come in and values go up in those cities when they go down elsewhere. So keep your ear to the ground as far as that goes. But I think that there's a lot of people that are looking outside of Canada. Don't be afraid to look in different markets, and don't be afraid to run an active real estate business. Pivot with the times. Don't be stuck in old things that used to work. If you have a real estate portfolio here, calculate your return. Factor in losing 1 or 2% a year in your property's value, and figure out what your return on equity is. Look it up if you're not familiar with return on equity and how you can calculate it. Decide whether maybe it makes sense for you to sell your property. What I'm suggesting here is that do a real evaluation of your strategy and of your existing portfolio, and see how that compares to what your long-term goals are. What is it that you want to do? What is it that you need to do? And how does that compare with what you are doing? And that should be somewhat enlightening. I think everybody would benefit from running through that exercise and just sort of journaling out these thoughts. Also, in closing, I do still think there's tons of opportunity in Ontario. There's tons of things you can do. There are great deals you can buy right now. Again, it's the how are you doing things that matters. So with that said, let's wrap up this episode. Again, if you're interested in learning about the passive investing strategies, investing in private equity, private REITs, and how you can use your RSPs, TFSAs to actually invest in real estate where there's a cash flow component and returns that I thought were interesting enough that I wanted to dig into this further. Make sure that you click that link and sign up for that webinar. I'm going to have Carmen Campanaro and Nick Wright on this event, and so respectively, Carmen's a monster developer, my mother-in-law as well, and real estate investor extraordinaire, and she has several funds and a REIT. And then Nick is an exempt market dealer, so he can talk to you about how that all works. All right, guys, we'll see you on the next episode. Thanks a lot. Hey friends, I'm sure you've been noticing that cash flow is getting a bit tougher with these higher interest rates. This is why I've noticed a lot of investors shifting over to a more passive approach and also to optimize their overall returns. Tune into my passive real estate investing webinar that I'm hosting on November 8th, 2023 at 7 p.m., where I'll have special guests Carmen Campanaro and Nick Wright talking about what private equity is, how you can invest in it, what private REITs are, and how you can even have your TFSAs and RSPs invested in real estate where it would otherwise not be possible. Space is limited to this webinar, so please take a moment now and register your attendance at www.andrew-hines.com/webinar, or go ahead and use the link in the show notes of this episode. I'll look forward to seeing you there.